Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. We are doing a really big deep dive today. We're looking at three major structural shifts that are basically reshaping global finance and supply chains.
Yeah.
If you've been seeing the news about all this massive spending on AI, new data centers, next-gen chips, it's pretty clear this isn't just a tech story. It's a huge capital event.
It really is.
So our mission today is to connect these dots, these seemingly separate events,
Yeah.
to show how big tech's money and, frankly, geopolitical decisions are changing the rules of the game.
That's exactly right. And I think we need to stop looking at these as just, isolated news items. When you see capital being deployed at this kind of scale, it creates friction.
Friction, how so?
In finance and the supply chains, we're seeing signals that tell us to look past the usual business cycle. Something more fundamental, more long-term is being restructured right now.
Okay, so we've boiled it down to three key pillars for today. First, we're going to tackle this mystery of why American tech giants are suddenly borrowing billions of dollars in Europe. They're calling it the reverse Yankee. Then we're going to jump over to Taiwan to unpack this incredibly strict end-to chip manufacturing rule. We'll get into what that geopolitical move means for the race to make the world's best chips right here in the U.S.
And finally, and this is where it all comes together, we'll connect that global spending spree to something really tangible.
Okay.
We're seeing reports of consumer PC stores in Asia literally starting to run out of basic inventory. And it's a direct result of AI's just massive appetite for memory components. It's a fascinating picture when you see it all connected.
All right, let's start with the money then, this reverse Yankee phenomenon. So recent analysis is showing U.S. corporations, and we're talking about the biggest players, the hyperscalers like Alphabet and processors like Visa, they're issuing bonds in euros at record levels.
The numbers are huge.
Yeah, the cumulative issuance hit something like $100 billion in 2025. And just so everyone's on the same page, when we say hyperscalers, we mean the giant cloud providers.
Yeah.
The ones building all that AI infrastructure.
And what's so fascinating here is just the sheer volume of it. It's totally counterintuitive. These are American companies earning dollars, right?
Yeah.
And they're borrowing a record amount in euros. They aren't facing a cash grab. I mean, just look at their balance sheet. So the big question is why? Why introduce all that currency risk?
That's the thing. Normally, borrowing in a foreign currency is just a complication, a risk you try to avoid. So if it's not a necessity, it has to be about optimization.
Precisely. It's financial engineering.
Yeah.
And it's driven by three main factors. The first one is just simple cost optimization. Now, stick with me here because it involves something called a cross-currency swap.
Okay, let's definitely unpack that because cross-currency swap sounds like something straight out of a finance textbook.
It does, but the concept is simple. Think of it this way. The U.S. giant sells a bond to a European investor. So they get euros today, and they promise to pay back those euros plus interest over, say, 10 years. That's their new liability.
Okay, a debt in euros.
Got it. Then, immediately, they go to a big investment bank and enter into a swap agreement. And that agreement basically says, hey, I'll trade you my euro debt for a dollar debt. The bank takes on the euro payments, and the U.S. company now just has to make equivalent payments in dollars.
So they borrow in euros, but the swap turns the actual debt they have to pay back into dollars. Why go through all that trouble?
Because the total cost is often cheaper. The sources are pretty clear that the combination of, good borrowing conditions in Europe and the terms of that swap often gives them a better final interest rate than if they just borrowed in the U.S. dollar market to begin with.
They're basically shopping around the globe for the best deal on a loan.
Exactly. They are arbitraging the global interest rate structure to find the absolute lowest cost for their long-term capital.
That explains the cost part.
Yeah.
But $100 billion, that's a lot of money to move for just a slightly better rate. What else is pushing them?
The second reason is investor diversification. AI spending is just exploding. Big tech's capital expenditure, their CapEx, has caused a huge surge in the supply of U.S. corporate bonds this year.
So they don't want to flood their home market.
You got it. If they kept piling all that new debt into just the domestic market, they would saturate demand, borrowing costs would go up. So by tapping the euro market, they spread it out. They find, as the data says, better prices where demand remains.
It's just smart risk management.
And what about the strategic side? You mentioned hedging.
That's the third factor, and it's really important for these hyperscalers. They're building data centers all over Europe. They have staff there, huge energy bills, real estate. All of that is paid for in euros.
I see. So by taking on euro debt, they create what's called a natural hedge. Their euro costs are offset by their euro debt. If the euro gets stronger, sure, their debt is worth more, but so are their European revenues. It balances out. It reduces volatility.
Okay, so this is a masterclass in global financial optimization. But what's the impact on Europe? I mean, if these U.S. giants show up with these massive, super high-quality bonds, what does that do to the existing European market?
This is the small shock, big impact part of the story, and it's really critical for investors to get this. The European investment-grade bond market, it's just a lot smaller. It's less deep than the U.S. dollar market.
And the hyperscalers need that long-term debt.
Ultra long-term, to fund their data centers for decades.
Wait, so just because these American companies have such good credit ratings, they're seen as almost risk-free,
Yeah.
they actually destabilize the market just by showing up.
That is the technical paradox, yeah. When these super safe issuers flood that long-term debt market, they basically erase the scarcity premium that other high-quality European bonds usually have.
Can you give us an analogy for that?
Sure. Think of it like a small, specialized vault that's designed to hold a certain amount of the world's purest gold. Now imagine a giant American truck backs up and just dumps 10 times the normal amount of equally pure gold into that vault. Suddenly, the specialness, the value of all the gold in there, it starts to fluctuate.
That makes perfect sense. So the risk isn't default.
No.
It's that they're creating so much new supply that it could actually widen spreads and hurt prices across the entire euro market.
Precisely. The price of all long-term credit in Europe, even for companies that have nothing to do with this, can fall just because the supply side suddenly exploded. It shows that AI's capital needs are literally changing how Europe prices its own debt.
Okay, that was the money side. Now, let's pivot from that capital optimization to what that capital is chasing. Advanced semiconductor chips, the engines of AI. And this takes us right into high-stakes geopolitics and this regulation called the N2 rule.
The N2 rule is a fantastic example of where technological sovereignty starts to trump, pure market efficiency. It's a really crucial policy tool.
Let's define it clearly for everyone. The N2 rule, which is being reviewed by Taiwanese authorities, says that Taiwan's top chip foundries, we're talking about giants like TSMC, will be restricted from making chips overseas if the tech is not at least 2 generations behind what they're doing back home, N-2.
So what that means in the real world is this. If TSMC is ramping up, say, 1 nanometer technology in Taiwan right now,
Which is the absolute cutting edge.
the absolute bleeding edge, the most advanced they could then produce in the United States in their new Arizona fabs, for example, would be the 3 nanometer line. It's a government-mandated speed limit on tech transfer.
And the context here is that TSMC is moving fast on its 3 nanometer line in Arizona. They're targeting 2027, and they're already planning for 2 nanometers in the U.S. So is this just, a boring industrial regulation?
Well, the sources suggest it's seen as much more than that. It's viewed as a geopolitical policy tool. Taiwan's strategic goal seems pretty clear.
Which is?
They want to keep the most advanced technology, the really critical manufacturing skills, the secret recipes, all of it, anchored securely on the island. It's a form of technological sovereignty. It gives them strategic leverage in negotiations, especially with the U.S.
So the U.S. is pouring billions in subsidies to get a secure supply chain.
Right.
But Taiwan is basically saying, you can have a secure supply, but you can't have our absolute best tech the second we invent it. That feels like a major constraint.
It creates a fascinating conflict. The N2 rule doesn't stop U.S. production, but it controls the timing and the generation you can get on U.S. soil. If Taiwan's technology moves ahead really quickly, Arizona's brand new 3 nanometer line could suddenly fall under that restriction.
Delaying access for American companies to the very best chips.
Exactly. It puts U.S. tech firms in a real bind.
Okay, so whenever a market leader like TSMC is held back by policy, it creates an opening for rivals. Who's the big winner here?
Well, this creates a pretty clear window of opportunity for competitors, and really we're talking about Samsung. If TSMC is constrained by its own government's timing, Samsung could potentially seize a lot of that demand. They could deliver advanced nodes like 2 nanometers reliably in the U.S. from their huge facility in Taylor, Texas, maybe earlier than TSMC can manage because of these regulatory hurdles.
The chip race is changing. It's not just about who has the best tech anymore. It's about geography and regulatory timing.
Exactly. But, and this is the key nuance for investors, it is an opportunity, not a guarantee. Samsung's success still comes down to execution, 100%.
You still have to deliver.
They have to nail the yield, which is the number of good chips they get per silicon wafer. They need the whole ecosystem of design software to support them. And, critically, they have to master advanced packaging.
Advanced packaging, what do you mean by that?
We're talking about technology like CoWoS, that's chip on wafer on substrate. It's non-negotiable for AI chips.
Okay.
It's the process of stacking high bandwidth memory, HBM, right next to the main processor. AI just needs a massive amount of memory bandwidth, and without this kind of advanced 3D packaging, the chips just can't perform.
So if Samsung can deliver the advanced chips and the packaging on U.S. soil before TSMC can,
They could win some very big, very important customer contracts immediately.
that really shifts the priority for investors then.
Yeah.
It's no longer just about who has the smallest nanometer process. It's about who can deliver the whole package on U.S. soils when the customer needs it.
That's the core takeaway. This tension between the U.S. wanting supply chain security and Taiwan needing that technological leverage, it's a growing structural trend. For you, the listener, the sources stress you should be watching for news about customer verification and actual production volumes. That's the real signal.
Okay, so we've covered the capital flowing through Europe and the geopolitical rules for the chips themselves. Now let's connect all this massive AI spending to a real-world physical impact on the average consumer. This is where the story gets, frankly, a little surprising.
It is. This is the story of the supply chain squeeze hitting the very end of the line. We are seeing reports that Japanese PC makers and even retail stores in famous districts like
Akihabara, the global hub for electronics.
the very same. They are halting new orders or delaying deliveries for key season components well into 2026.
Wait, they're literally running out of stock. That
Yeah.
sounds less like a normal shortage and more like a structural breakdown.
It is a structural failure, but it's driven by supply reallocation.
Yeah.
This isn't happening because of some huge sudden surge in PC demand from consumers.
Right.
The shortage is being driven entirely by AI's insatiable demand for high-value components, specifically DRAM and NAND storage. That's the memory and the flash storage in your SSDs. Prices are surging, and crucially, inventory is just being pulled out of the consumer channel.
It's like the consumer market is being starved by these industrial giants. Can you give us an analogy to really help us grasp what's happening?
Okay, think of it like a restaurant. You have one enormous customer, that's big tech, building these AI data centers, who walks in and orders 90% of the kitchen's best ingredients for a single long-term event.
A huge banquet.
A huge banquet. They place these massive, exclusive contracts to secure vast quantities of the highest-end memory, things like HBM or specialized server DRAM, directly from the main suppliers, Samsung, SK Hynix, Micron.
And the average person, the one just trying to buy a new laptop or a gaming PC.
You are sent to the back of the line. Or you're just told the kitchen is closed to you because the suppliers are obligated to fill those huge AI contracts first. The sources confirm this is a structural supply reallocation. AI is consuming all the high-margin supply and literally pushing other markets out.
And the fact that this is showing up in Japan first, why is that such a big global warning sign?
Because of the inventory timeline. Usually, supply shocks, they work their way slowly through the system. You see contract prices go up, then that hits the manufacturing costs, and then finally, way at the end, it hits retail inventory.
So the fact that stores are already halting orders.
When retail stores are posting signs about delivery delays into 2026, it signals that the physical shortage has reached the most visible final stage. It's confirmation that this memory supercycle is being driven by a priority shift from AI, not just slow price increases.
This creates a really strange paradox for the market, doesn't it? I mean, rising prices are great news for the memory makers like Micron,
Fantastic news for them.
but they're a disaster for PC manufacturers and the whole consumer ecosystem.
That is the asymmetry of risk right now, and it's a serious concern. While the memory suppliers' profits are booming, if prices climb too high or if the parts just aren't available, PC makers can't ship their products. And that leads to what we call demand destruction.
Meaning if you can't buy a new machine, that demand just disappears.
It disappears. The whole sector slows down.
So the semiconductor story is no longer one single story. It's highly segmented now.
Yeah. Very segmented, yes. Investors have to look very closely at who actually controls the bottleneck in the supply chain. The AI-facing companies, they benefit massively. They thrive. But traditional consumer electronics, which are lower margin and need that same supply, they face price hikes and a potential collapse in demand because things just aren't on the shelves. That signal from Japan is a global warning.
This has been a really connected deep dive. We started with the financial engineering of the reverse Yankee, saw how U.S. capital is optimizing itself by moving into foreign credit markets. We then looked at how geopolitics, specifically that N2 rule, is now defining the timeline and the physical location of advanced manufacturing. And finally, we saw how AI's raw appetite for materials is literally starving the consumer tech market.
These stories, when you put them all together, they show that technology and global finance are operating in a state of, let's call it, hyper-optimization, but under increasing policy constraint. AI isn't just a software theme, it's a global capital event that is redrawing the rules of business and supply. And that discussion we had about the euro debt and the N2 rule, it really shows that in this new AI economy, success for a company hinges less on, say, avoiding default and far more on resource allocation. Who can secure the cheapest capital on the planet, and who can secure the supply chain timing? For you, the listener, the challenge is separating that cyclical noise from these lasting structural changes.
Absolutely fascinating. Don't forget to subscribe and hit that like button.